Hello, my name is John Barker, and I am the Managing Partner for WMC Business Services LLC. And in California, we are known as WMC Integrated Insurance Services LLC. The purpose of this short educational video is to show how health insurance premiums are determined. WMC Business Services LLC is a health insurance broker. We have developed some unique and innovative programs to help individuals, families, and companies lower healthcare costs. This video is part of a series to provide information about health insurance in general, especially with the full implementation of healthcare reform coming in January 2014, and to explain our new programs to help. Health insurance is basically a prepay system with a portion of your premiums earmarked to cover small claims. The health insurance carrier also purchases protection in case of large catastrophic claims. When you are insured on a company plan, there is a risk sharing by the employee, the employer, and the carrier as to which party will pay for what part of a claim. Individual and family plans work much the same, but only the individual and the carrier participate. The insurance carrier has a pricing model that will look at the demographics of the group, the plan design chosen including deductibles, copays, and coinsurance, as well as other factors to determine the correct rate for a company. First, based on these factors, the health insurance carrier projects what they expect the group to use in actual claims costs for the next year. They then determine how much an employer's plan is responsible to pay for small claims for each of the employees and participants. The carriers then purchase a larger deductible policy for each of the participants. In this example, the carrier is purchasing a $25,000 policy for each of the participants. The employer's plan is responsible for all costs below the $25,000. The health insurance carrier will then look to put in some type of protection in case many people in the group use the plan heavily. This is called an aggregate stop-loss. The health insurance carrier usually purchases a stop-loss policy from a reinsurer to protect the employer and the health plan. This is an additional cost to the health insurance plan. In this example, the expected claims are $150,000. And the employer is responsible to pay for up to $25,000 for claims for each of the participants. The stop loss will kick in and be paid by the reinsurance company once all claims that the employer plan is responsible for reach $200,000. Then money is set aside from the premiums to help fund a reserve account. This is set up to help employers or individuals pay for claims costs that are above what is expected but under the aggregate stop loss. The insurance carrier then adds an administration fee to help cover the costs associated with running the health plan. These costs can include commissions for agents, claims administration costs, taxes and fees at the federal and state level, and expenses incurred by the carrier to be in business. The health insurance carrier then adds up all of the expected expenses for the year to arrive at a total. The health insurance carrier then takes the annual total and breaks that up into monthly payments for the employer and employees to pay for their health insurance. If everything goes as planned, a portion of each month's premium payments go towards paying claims for the group. If there are more claims that come in before a company pays enough premiums to cover the claims, the health insurance carrier has to wait to pay the claims until there is enough money or borrow from the reserve fund to pay the claims. This is a continual juggling act for the health insurance carrier, as claims do not always coincide directly when premiums are set to come in. What happens at the end of the plan year? The health insurance carrier looks at what your plan has used to make a determination and calculation for the next year. If your plan uses what is expected, then the calculations are usually fairly simple, and your company plan may receive a rate increase similar or on average with other companies. This rate is usually called a trend rate and has been averaging 10 to 16% or more for a number of years. What happens if your company plan uses less in claims costs than is expected? In the example here, I am showing $100,000 in actual claims costs instead of $150,000. Like with your family budget or your budget for your business, if you have money left over, you do not have to budget as much money for the next year. In this case, the medical carrier, based on their calculations, can give a smaller rate increase or even a rate decrease if their rating structure and the demographics of the group warrant it. Health insurance premiums can go down if claims costs go down sufficiently. Now in the example, let's see what happens when a plan has higher than expected claims costs. If the plan has $200,000 of actual claims costs, what happens? First, if your family budget or your company budget is short, you will need to borrow from your savings or from a bank or lender. Then at the end of the year, you will need to pay that money back as you make your new budget. The same thing happens with the health plan. They borrow from reserves to make up the additional costs. When the health carrier goes to determine your rates for next year, money has to be returned or paid back to the reserve fund along with the calculations for your plan for the next year. This is where plans can have a larger than expected rate increases until healthcare claims costs can go back down. If they do not go back down and continue to rise, then health insurance premiums, copays, deductibles, and co-insurance all continue to rise. This may not be exactly how all premiums are determined, but it is close. It does not matter if it is for a large company who is self-insured, a medium-sized company that is fully insured with a carrier where the rate experience is a factor, or another plan that pools a number of small companies or individuals together. All of these plans will base premiums in some way based on usage over time. This also includes the new exchanges. The only way to drop health insurance premiums is to lower usage or to shift that usage. The programs at WMC Business Services LLC can help individuals, families, and companies do both. This is an actual quote for one of our clients. The specific participant deductible in this case is $25,000. The aggregate stop loss for this group is $113,734. The stop loss premiums are $1,532 per month. The administration, sales, and general expenses is $1,192 per month. The expected monthly claims cost for this group is $3,336, and all of this totals $6,088 per month for premiums for this group. This is then divided up into monthly premiums for the group participants in the middle, where the employee rate is $466 and more when dependents are added. I encourage you to view the entire series of videos to see if any of our programs are right for you, your family, or for your employees. If you found this video on YouTube and not by email, search YouTube for the following videos from WMC Business Services LLC. Introducing the WMC Discount Health Program, WMC Discount Health, Importance of the WMC Discount Health Program, WMC True Cost of a Doctor Visit Copay, WMC Alternative Health and Wellness, WMC Chiropractic Care, and the WMC Nutrition Program. I promise the information is important as we move closer to the full implementation of healthcare reform. To learn more about WMC Business Services LLC, visit our website at wmcbusinessservices.com. While you are on the website, I encourage you to sign up for our blog. We will continue to place educational material on the blog. This will help everyone learn how to maximize the cost savings from our programs and for additional information on how to help you, your family, and your employees be healthy and well and to save money. You can also contact us by phone at toll-free 888-334-2334 or by email at info@wmcbusinessservices.com.